There's been a lot of controversy this year surrounding one of the most popular dividend growth ETFs out there, which is SCHD. The Schwab US Dividend Equity ETF has been underperforming a lot in 2023 when compared to the S&P 500 as well as other dividend growth ETFs. A lot of people have been discouraged with the underperformance of SCHD, and some people are considering or have already sold out of it in hopes of finding a better performing dividend ETF. So in today's video, I thought it'd be a good idea to take another look into this fund and try and determine why it's been underperforming the market and what we can expect from this fund going forward. So with that being said, let's get started. I'm assuming that the majority of people watching this video are probably familiar with this fund. It's a passively managed ETF that tracks the total return of the Dow Jones U.S. Dividend 100 index. The index holds a lot of slow growth blue chip stocks that have consistently grown their dividends over a long period of time. The majority of what this fund holds are dividend aristocrats and dividend kings, which are companies that have increased their dividends every year for decades. Today, SCHD is one of the largest dividend ETFs and one of the largest ETFs in existence, having over $46 billion in total assets under management. Not to mention, it also has a very low expense ratio at just 6 basis points. The biggest concern people have for SCHD is its underperformance. If we take a look at this fund's share price, we can see it's currently down 6.22% for the year, and this is without factoring in the dividends being paid. Right now, this ETF is offering a dividend yield of roughly 3.76%, which is one of the largest yields for any of these dividend growth ETFs. To compare the performance of SCHD with the S&P 500, we can see this dividend ETF trails behind by a large amount in share price. If we use a drip calculator, which calculates the total return of a dividend holding with dividends being reinvested back into the fund, SCHD is still down about 5.21% for the year. So with this in mind, why has SCHD been performing so poorly this year? There's really two major forces at work going on here that have resulted in this ETF as well as many other dividend-paying securities going down in share price. Those two forces are interest rates as well as inflation. If you're a regular viewer of my content, you'll know that I talk pretty frequently about how interest rates negatively impact stock prices. There's an inverse relationship in the stock market between stock prices and interest rates. When interest rates are increased, then markets go down because of pessimism spreading. This is because when interest rates are increased, this leads to higher costs for corporations. Money becomes much more expensive to borrow, and thus growth slows down for many companies. Some companies that need money and can't afford to borrow at rates due to being so high will instead issue new shares of their stock to raise money. Diluting shareholders by adding more shares of a stock usually results in the share price going down. Plus, any corporation that holds floating rate debt on its balance sheet will now have increased expenses, which can result in lower net income. As you can probably imagine, lower net income means that stock values will fall to adjust for the reduction in earnings. For stocks that pay dividends, like the ones that SCHD holds, they can be more negatively impacted than stocks that don't pay dividends. That's because dividend-paying stocks come under more pressure when interest rates are high. No company ever has to pay a dividend, therefore the ones that choose to pay dividends as opposed to saving that money to do things like expand or pay down debt can potentially be less stable. It might seem like when the markets are tanking that many people would choose to run towards safe-paying dividend investments for stability. And while it is true that some sectors do perform much better than others, oftentimes dividend-paying holdings can fall just as hard, if not worse, than the market in general. But while this information provides an explanation as to why dividend stocks are still falling, we should try to figure out why SCHD specifically is performing worse than other dividend-paying ETFs. For example, the iShares Core Dividend Growth ETF, ticker symbol DGRO, is only in the red by about 1.74% for the year. With dividends being reinvested back into this fund, the results are positive. The Vanguard High Dividend Yield ETF, ticker symbol VYM, is currently down 6.2% for the year, which is a little better than SCHD. Then there's also the iShares Core High Dividend ETF, HDV, which is also doing better than the Charles Schwab ETF. So with this in mind, I thought it'd be a good idea to look inside the holdings of SCHD and see if maybe one of their largest holdings are performing badly this year. After comparing all the ETFs I just previously mentioned with SCHD, I noticed that industrials make up the largest percentage of their holdings. According to Seeking Alpha, industrials make up 17.92% of this ETF's holdings. Next is healthcare at 16.85%, and then financials at 14.95%. What I did next was look at the indexes for all of these sectors to see if any of them stand out. According to the Dow Jones indices, the S&P 500 Industrials Index is currently up 4.78% for this year. So this category doesn't seem to be the issue with this ETF. I looked at the next index, which is the S&P 500 Healthcare Index, and noticed that this one is down 3.62% for the year. Finally, I moved on to the S&P 500 Financials Index, and I saw that this one was down 2.8% for the year. With this in mind, this could help explain why SCHD has been down further than any other diversified dividend fund. But honestly, none of these are down that bad, so I decided to take a look at some of the largest holdings inside this ETF and see if any of them were in trouble. Their top holding is in a company called Amgen, ticker symbol AMGN, and it makes up 4.48% of SCHD's holdings. They're a biotechnology company that develops, manufactures, and delivers human therapeutics. Looking at their share price performance, it seems clear that this holding isn't negatively impacting this fund, and on top of that, this company has steadily been increasing their dividends every year for over a decade. This year, they had one of their largest dividend increases to date at 19 cents. Their next largest holding is in a company called AbbVie, ticker symbol ABBV. They're a pharmaceutical company that develops treatments for things like Parkinson's disease, arthritis, and blood cancers, among many others. Now, I've covered this stock a few times on this channel before because for a while, they were one of the highest yielding dividend aristocrat stocks. Although things continue to be fine for AbbVie from a fundamental perspective, the market has been weary in regards to this stock this year. That's because one of their best-selling products, Humira, is losing market exclusivity this year. This means that other pharmaceutical companies are going to be allowed to make and sell their own alternatives to Humira, which will erode their market share. ABBV is currently down almost 9% for this year, but they've still continued to grow their dividend for many years. Let's look at one more company, which is Chevron, ticker symbol CVX. They're most well known for being an oil company, but they do a bunch of other things like produce plastics for industrial use, do natural gas transportation, and make lubricants for various products. This stock, along with most other oil companies, are cyclical, meaning that they'll perform exceptionally well during certain periods and can severely underperform in other periods depending on the economy. For this year, CVX is currently down roughly 4.2%, which isn't too good, but this stock, just like a lot of others in SCHD, are dividend aristocrats. This company's been able to grow their dividends every year for more than 35 years and counting. We could keep going on, but we just looked at roughly 13% of SCHD's portfolio. Just by glancing over the rest of their holdings, we can see a lot of stable companies like Pfizer, Cisco, Texas Instruments, Pepsi, Coca-Cola, and many other dividend aristocrats and even kings. Verizon has been getting demolished this year and a half, which would have to be a contributing factor to SCHD's underperformance. But there isn't any holding here that would cause any serious red flags in my opinion. SCHD isn't as well diversified as some other ETFs like VYM, but it still holds a lot of the same consistent dividend stocks that are just underperforming in our high interest rate environment. If you look at the dividend distributions for SCHD, you'll see that everything has continued to move upwards in terms of dividend growth. This fund doesn't pay a consistent dividend each time in that it changes from quarter to quarter, but nothing has stopped or even slowed down the dividend growth for this ETF. Seeking Alpha is currently giving SCHD a 5-year dividend growth rate of 13.69%, and it has grown every year since inception. This growth rate beats every other high-yielding growth ETF that we just looked at earlier by a huge majority. Coming in second is DGRO with a growth rate of 9.66%, and it's still really good, but just not as good as SCHD. So in the end, with all things considered, is SCHD in trouble? This ETF does hold some positions that are underperforming and are also higher yielding. On top of Verizon, this fund also holds Altria, which isn't a terrible stock, but it hasn't performed too well for a number of years. It also holds a few other lackluster performers that are also high-yielding, like 3M and Leggett & Platt. But nearly all of these make up less than 2% of SCHD's total holdings. In the end, I'm not seeing any indication that this ETF is in any kind of trouble. It's just been trying to recover with interest rates being so high, and it's having a difficult time doing so. I don't believe that investors should pull out of SCHD and search for a better dividend-paying fund. Because first, none of them are actually doing spectacularly great so far this year. But second, SCHD will continue to move upward over time. This fund holds way too many well-run companies and it's just taking a little more time for it to recover. Whether you invest in SCHD or VYM or something different, I would always advise to stay invested in one of these well-diversified dividend growth ETFs because you don't want to miss out on the recovery when it comes. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.